In 2026, most investors won't lose money because of a market crash. They'll lose it because of behavior. Small decisions, repeated mistakes, emotional reactions. Wealth destruction rarely looks dramatic. It looks subtle. It happens when you chase hype, overpay, panic sell, abandon discipline. And here's the uncomfortable truth. Most people already know what to do in investing. They just don't do it. Warren Buffett didn't become one of the wealthiest investors in history by predicting the future. He did it by avoiding catastrophic mistakes. Today, we're breaking down the 7 wealth-destroying mistakes most investors will make in 2026, and why Buffett refuses to make them. If you avoid these, you're already ahead of 90% of the market. Mistake number 1, trying to get rich fast. Let's start with the most dangerous mindset in investing: speed, the desire to get rich quickly. Every market cycle produces it. In 2020, it was speculative tech. In 2021, meme stocks. In 2023 to 2025, AI hype cycles. And in 2026, there will be another narrative. The problem with chasing fast gains is simple. It forces you to abandon valuation. Buffett once said, "The stock market is designed to transfer money from the impatient to the patient." Fast money thinking creates overconfidence, overexposure, poor risk assessment. Buffett built wealth through compounding at steady rates, not explosive gambling. Compounding doesn't look exciting, but over decades it becomes unstoppable. Trying to accelerate compounding often destroys it. Mistake number 2, confusing volatility with risk. When markets drop 20%, most investors assume risk has increased. Buffett thinks the opposite. Volatility is price movement. Risk is permanent capital loss. If a strong company drops because of market fear, but its long-term earnings remain intact, is it riskier or cheaper? Most investors equate falling prices with danger. Buffett equates falling prices with opportunity, if fundamentals remain strong. In 2008, many quality businesses fell 40 to 60%. Those who understood intrinsic value built generational wealth. Those who panicked locked in losses. In 2026, volatility will come again. The question is, will you interpret it emotionally or analytically? Mistake number 3, investing outside your circle of competence. This mistake quietly destroys portfolios. Investors see a trending industry. They don't fully understand it, but they invest anyway. Buffett has always emphasized, stay within your circle of competence. He avoided businesses he couldn't predict. Instead, he invested heavily in companies like Coca-Cola, American Express, simple business models, durable demand, understandable economics. If you cannot clearly explain how a company makes money, what threatens it, why customers stay loyal, then during a downturn, your conviction will collapse. And conviction is everything in volatile markets. Mistake number 4, overpaying for growth. This is subtle. Investors love great companies, but they ignore price. A wonderful business can be a terrible investment at the wrong valuation. Buffett always demands a margin of safety. He doesn't just ask, "Is this a good company?" He asks, "Am I paying a price that protects me if I'm wrong?" When optimism peaks, valuations expand. When reality hits, prices compress. Overpaying creates fragility, and fragile portfolios crack first. Mistake number 5, no cash. Cushion being fully invested feels bold, but it removes strategic flexibility. Buffett consistently holds significant cash within Berkshire Hathaway. Critics argue he misses upside, but when markets drop, that cash becomes power. Cash provides emotional stability, buying opportunity, downside protection. In 2026, if markets correct sharply, Will you have liquidity, or will you be forced to watch? Cash isn't a drag. It's optionality. Mistake number 6, letting headlines control you. Modern investors are bombarded with information, inflation numbers, interest rate predictions, political noise, recession fears. Constant exposure increases emotional decision-making. Buffett doesn't invest based on headlines. He invests based on business fundamentals. He filters noise. Most investors amplify it. If you check markets 10 times a day, you increase anxiety. If you build a thesis and revisit quarterly, you increase clarity. Information overload destroys discipline. Mistake number 7, short-term measurement. This is the silent wealth killer. Investors judge success monthly. Buffett judges success over decades. If you expect validation within weeks, you will overreact. True wealth is built through consistency, reinvestment, time. Compounding needs duration. Short-term thinking interrupts it. The investors who succeed in 2026 will not be those who predict correctly. They will be those who remain steady. Why 2026 will reward discipline? We are in a structurally different economic era. Higher interest rates than the 2010s, rapid technological shifts, shifting global supply chains, increased market volatility. This environment punishes speculation. It rewards balance sheets, cash flow, durability. Buffett's principles become more powerful in uncertain environments because uncertainty increases pricing mistakes, and pricing mistakes create opportunity. Historical reinforcement. Look at previous downturns: dot-com crash, financial crisis, pandemic crash. Each felt catastrophic. Each eventually became a footnote on long-term charts. Investors who avoided catastrophic mistakes compounded massively. Investors who reacted emotionally reset their progress. The market recovers. Emotional mistakes don't. Final summary. The 7 wealth destroyers. Avoid these in 2026. Chasing fast money, confusing volatility with risk, investing outside competence, overpaying, no liquidity, reacting to headlines, measuring short-term. If you eliminate these, you dramatically increase your odds of long-term wealth. Wealth isn't built through brilliance. It's protected through discipline. The biggest danger in investing isn't inflation. It isn't recession. It isn't interest rates. It's your own behavior under pressure. If you can remain rational while others panic, you won't just survive 2026. You'll position yourself to thrive. If you value disciplined investing and long-term thinking, subscribe to Modern Buffett Strategy. Because markets test everyone, but only disciplined investors pass.